Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our commentary on economic and market events. Let's get started. This week's video is going to expand on our recent publication, The Beginning of the End of Big Oil. I believe that when the future history books are written, they'll look back on May of 2021 and identify last month as one of those critical turning points when the decline of big oil as the main provider of global energy became inevitable. And after which the decline of big oil accelerated, gained momentum, and became unstoppable. Now, as I go through this analysis, I want to make it clear, I'm talking about what has happened, not what I believe should happen. I figure you want me to talk about what has happened and what its implications are for your portfolio, and not know what my particular political opinions are. So don't take anything that I'm saying as either a criticism or an endorsement of what happened in the month of May. It is just what I hope is a clear-eyed analysis of the facts. And the facts is that big oil had a really, really bad month. Right? There was a major court in the Netherlands that ruled that oil companies will need to adhere to the greenhouse gas emissions that their host country committed to through the Paris Climate Accords. And not only did they say you need to worry about the emissions that you, Shell Oil, are emitting, you are responsible for reducing the carbon emitted by all of your products after you sell them. That means essentially that Shell Oil is responsible for the carbon emitted by every car, every airplane that fills up with their products. And second, unbelievable body blow that the oil industry took was the International Energy Association. This is a research group that was put together in the 70s after all the oil crises that we went through. Western democracy said, let's pool together our resources and our research scientists so that we make sure that we never get caught flat-footed again and that we are not caught with short of oil. So this very respected nonpartisan research organization put out every year they put out a giant report that's their big think piece. They put out their seminal 2021 report, and it called for an immediate end to all investment in new oil and natural gas wells, like starting today. Now, you know that things are moving rapidly against the oil industry when the IEA's recommendations are more radical than the Green New Deal. Third thing that happened is that big, giant asset management companies that have always kind of been aligned with big oil, because big oil has been a hugely profitable investment for the last 120, 150 years, big asset managers like BlackRock, State Street, and Vanguard voted their proxies to put two environmental activists onto Exxon's board of directors. Now that has consequences far beyond simply there's going to be some environmentally friendly voices on the Exxon board, because historically money managers don't do this. There's what's called the Wall Street rule. And what that says is, if you're a money manager and you don't like the decisions management is making, you don't vote your proxy and get your representatives on the board of directors and try and take control of the company. That would be rude. Instead, you just sell the stock. Well, that's not what BlackRock, Vanguard, and State Street did. And I think there's probably a reason for that. They dominate, those are three dominant players in the ETF industry. ETFs are passive investment vehicles. That means they just buy all the stocks that are in a particular market. So they've always got to own Exxon and all the other big oil companies. And I think what they've decided is that if we have to own these companies, then we're going to start voting our proxies to change their strategy when it comes to carbon emission, global warming, etc. So this is huge because the board of directors is now much more environmentally friendly, 2 out of 12 voices, and future proxy fights, you may have to look to the biggest money management companies in the world are going to continue voting along the lines of increased carbon reductions, emission restrictions. And just when you didn't think that there could be any more bad news for the oil industry in the month of May, you had Ford announce and have the President of the United States test drive an electric version of the most popular vehicle in the world, the Ford F-150. And General Motors made an even more dramatic announcement where they committed to eliminating all gasoline-powered vehicles by 2036. So they're saying we're going to be all electric. We're going to sell nothing that needs gasoline from big oil in the next 15 years. So when you step back from all that, big oil lost in court. They lost in the science with the IEA report. They lost huge allies in the big money management companies, and they lost big customers through Ford and General Motors. That is a body blow. And I suspect that May will represent one of those crucial turning points after which events kind of gain a momentum of their own. And oil companies could be besieged from external events similar to tobacco company. Big tobacco was besieged all through the 80s and 90s with tremendous damage to shareholders in those companies. And there's a huge difference between big tobacco and big oil. If you're addicted to nicotine, there is no substitute to big tobacco. But none of us are addicted to oil. We just need to drive places. And what Tesla has proven is that owning an electric car is a pretty great experience. They're more reliable, they're faster, they handle better. They definitely don't have the range, and recharge time is an issue, but as technology is advancing, even those competitive advantages of petroleum-based vehicles are falling fast. So unlike big tobacco that could cling to the fact, hey, people can't live without our product once they're addicted, big oil, we can live without. In a lot of ways and in a lot of the places that we use it. Now, don't get me wrong. 150-year dependence on oil across the global economy isn't going to end in a single month or a year or even a decade. But I think the die is cast. And equity markets look to the future to cast out what earnings and return on investment might be. And I think what we can look at now is a world where earnings and return on investment for big oil is going to be increasingly constrained by increasing costs of reducing emissions and reducing sales as their biggest customers convert over to electrical power. So, what are the investment implications of all of this? So, first and probably foremost is oil has been one of the big beneficiaries of the reopening economy. Oil stocks are up on average about 50% so far in 2021. What a great opportunity to take some profits and go somewhere else with better long-term prospects, in our opinion. All right, that's number one. Number two, expect, in kind of maybe counterintuitively, but expect oil prices to be persistently higher for the next few years. You're like, well, how can that be if you're saying that oil demand is declining? Well, it could be that oil supply declines even faster. The IEA is saying, don't invest. And banks and investors are looking at the potential return on investing in new oil wells, and they're saying there may not be a great return on investment there. That has huge implications for U.S. oil production. The big story of the last 15 years is the U.S. going from being like number 6 or 7 globally in oil production to number 1 or 2. U.S. oil production between 2006 and 2012 doubled from 6 million barrels a day to 12 million barrels a day. And it's fluctuated since 2012, 2013. It's fluctuated between 14 million and 11 million, depending upon the price of oil. All right, we are a dominant player in the oil market, but all that dominance and all that production depends upon fracking technology. And the thing about fracking wells, unlike traditional oil wells, a traditional oil well, your risk was you put a hole in the ground, you didn't hit oil. But if you did hit oil, that well might produce 20, 30, 40 years. In fracking, you put a hole in the ground, they know where the frack shale is. You're pretty likely to hit oil, almost 100%. But the well only produces at peak capacity for 2, maybe 3 years. Then production declines really fast, which means fracking producers have to continually be reinvesting in new oil wells. If the IEA recommendations restrict investment, not because people are paying attention necessarily to the IEA, it has no legislative authority, but because they're saying, oh my gosh, my return on oil investments are going to be falling. If there's a restriction in investment in new fracked wells, U.S. oil production will decline fairly rapidly over the next 2 or 3 years. And that's going to give pricing power to folks in OPEC and in Russia. And that could mean that the days of $40 a barrel oil during COVID, they're gone. The days of $60, $70 a barrel of oil, which has been the average for the last 5 or 6 years, that's where we are right now. It may be that oil continues to creep up and creep up. But unlike historical periods, when oil went up, big oil went up too. In this case, oil prices could go up, but because of that fundamental long-term worry about profitability and return on investment in big oil companies, those stocks may actually diverge. And you have seen this happen since May. Oil has continued to go up, but the stocks of oil companies have not. All right. Okay, so those are some of the risks that are out there. What are some of the opportunities? So, first of all, what is the potential big oil of the next 50, 60, 70 years? It's battery technology. Now, there is a temptation when there are these revolutionary changes in technology to go chase the sexy, hot, new startup companies, or to say, oh my gosh, Tesla is going to sell every car in the world, and at 600 times earnings, they'll somehow grow their earnings fast enough to be worth that. Well, the amazing opportunity right now is you don't have to do either of those speculative things. You could just go out and buy Panasonic. Panasonic is at 17, 18 times earnings. It's got a 3% dividend, and they are the sole provider of batteries to Tesla, and they're signing agreements with every other car company to provide batteries. Tesla's going to be competing with lots of folks. Panasonic kind of owns the battery market right now, and they're a whole lot cheaper. So if you're inclined to speculate, I would say don't speculate, invest, and do something a little safer. Right? Also, Panasonic is well below its 2018 highs, despite this huge new market that's opening up for it. All right. Second thing you can do is you can look at boring utility companies. And you say, why would I want to do that? There's all this exciting transformation of the economy. Why wouldn't I want to speculate on some of the folks that would really give me a 500% return? Well, utilities are obvious beneficiaries. When we don't fill up at the pump with gas, we're still going to drive, and we've got to fill up at the meter with electricity. That means there's going to be more revenue for these utilities. The utilities are largely regional monopolies, so there's only one place to buy that electricity from. And they are highly leveraged in both operationally, they have high fixed cost, they are financially leveraged, they have a lot of debt. And that means that when their revenue goes up, their profits and cash flow can go up a lot faster than their revenue goes up. And yet utility companies are sitting there trading at 20 times earnings, and they, like Panasonic, have about a 3% dividend yield. not too shabby, a kind of conservative, safe way, boring way to play a dramatic transformation. You may say, well, wait a minute, don't utilities have a lot of cost in converting from natural gas and coal-fired electricity to more carbon, less carbon emitting sources? Yes, they do, but guess what? All of the infrastructure bills have subsidies to help them make that conversion and absorb some of the costs. So even that doesn't seem to be a reason not to get excited about what would normally be a pretty boring part of the financial markets. One last thing you could think about, and this one is right down, everybody's already as long Google and Apple as you can possibly be. But the challenge with a Google and an Apple is, where's your next $1 trillion opportunity? Because these companies, Apple's worth about $2 trillion, Google's worth $1.6 trillion. Good Lord, where do you find enough opportunities to keep growing? Well, in this case, the automobile industry could be just that. And Google is developing an Android equivalent for automotive car manufacturers. So just like they make the software for phone handsets and let other companies worry about making the actual phone, they're doing that exact same model for the automotive industry. In the case of Apple, as they did with phone handsets, no, we're going to do the software and we're going to do the hardware. At least that's what's rumored. Unlike Google, which has been very upfront about what they plan, Apple's been very cagey, but most analysts think that they're working on a unified software, hardware, integrated car solution similar to Tesla. And, where can you find another $1 trillion opportunity? In the automobile industry. So, just to summarize, we feel like May's events, any one of those 4 events in May would have been hugely important. But when all 4 occurred within the space of a couple of weeks, we think it marks a major turning of the tide against big oil and their fight to prevent further carbon restrictions. We worry that this means long-term a decline in the oil industry. They are, without question, devoting a huge amount of cash flow and resources to try and create new products to prevent a decline in their stock and in their long-term prospects. But when I look at the history of these kinds of industry transformations, whether you're talking about film photography or you're talking about mainframe computing or department stores, it's really hard to find companies that successfully transitioned out of an industry that technology was leaving it behind and into the new industry. For the most part, none of those companies were ever the same, and I suspect that history may once again, if not repeat, at least rhyme. And therefore we think that the opportunities are, look for battery technologies, look for utilities, and when there's a technological transformation, technology companies tend to be the beneficiaries. Thanks for joining us for Market Insights. We hope you found it informative. If you would like to get more of our research, you can subscribe at the link below, or you can check out our publications on caravelconcepts.com. Also, if you like the video, we appreciate if you give it a like and maybe share it with your friends. Thanks.